is currently a postdoc with Dalia Malchi at UCSB, and he's an incoming professor at Ben-Gurion University in Israel. He's interested in many topics like behavioral economics, but also DeFi. So what he's going to present right now is more on the CS side. So let's give it up for Nir.
Thanks, Aviv, for the introduction, and thanks for hosting me. Yeah, so today we're going to speak on AMMs. So it's a joint work with Robert from computer science, Kite, which used to be in the UCSB econ department and now is in Uniswap, and Dalia Malki from computer science, of course. So as you see, the name of the paper is Clever Ordering of Transaction on AMMs, but let's start with a little bit, give you a background and introduction about the topic. So I want to give some motivation why we should care about ordering transactions on AMM. So I guess you familiar with DeFi, so I don't need to spend too much time on it, but DeFi kind of give us a special way to in the financial system to trade, to do financial transactions in transparent and in immediate way, and we can update prices continuously. In addition, we can do very complex automated transactions in a permissionless way. And it's give a lot of options, a lot of innovation. But one issue or something that is a little bit complex in this environment because of the way that blockchain networks works, currently we don't really have a way to regulate the order of the transaction. So block builders kind of have a monopoly power to order transaction as they want, especially in Ethereum. And this can generate issues because the order of transactions have like financial value. And if we specifically speak about decentralized exchanges, so we know that AMMs, it's a big deal right now. Just to get numbers, it's for a few years, every day the trading volume is more than $1 billion. And there is a lot of discussions, especially now in the last few months, about even leveraging AMM and do it as a trading mechanism in traditional markets, stock markets, foreign exchange, and much more. But one issue that we have in the blockchain system currently with AMM is by structure, and we will go more and discuss it. There can be price manipulation because of the order issues like sandwich attacks. And the market right now of sandwich attack is approximately 120 million annually. And besides sandwich attacks, there is much more options to do manipulations of orders in AMM, and I will speak about it later. So this is kind of why order of transaction matter, especially in decentralized exchanges. And then, like, if we want to think about more traditional finance, so the order of transaction is always something that is not easy and always was an issue. So I don't know if you're familiar with this book, Flash Boys, but Flash Boys basically is a book that explains how traders always compete on the speed to execute a transaction, because most of the time what happens is that there is a new signal in the market, new information, and people want to react to the information, and then there is a competition of speed of who going to buy, sell transaction faster than the others and enjoy the benefits from this information. So in the past, it used to be that there was a competition of moving information from New York Stock Exchange to Chicago Stock Exchange, and the competition in the past was who have stronger horses or whatever. And these days the competition is, as you know, is more about the speed of the computers and the access to the stock market, internet, or whatever, and we know it as the high frequent traders kind of a competition. So one way that traditional markets try to deal with this issue was by something that called batch auction, which was a market design that tried to actually fix or kill the speed competition and make it be a little bit more equal and so on. Now, when we move to DeFi, and this is basically the reason why they call this paper, I guess you're familiar with him, Flash Boys 2.0. It's basically to say that in DeFi we have something similar. There is an issue about an advantage that people can do by order, and it's mainly come from what I described before, that when a block builder builds the block, he has some monopoly power to do the order of transaction as he wants, and then it's the same game as I discussed before. Now, a question is how we want to deal with this issue in the context of the DeFi. So many papers kind of focus more about preventing like MEV activities. But what we want to do in this work is more to say something about what order going to be the best or the optimal. And after thinking about what is our goal, then we can pick an order that's going to implement our goal and less only focusing on MEV per se activity. So this is the big picture. Any questions so far? Okay. If yes, feel free to ask. I want it to be kind of an open discussion as much as we can. So what people try to do in order to solve the order issue in decentralized exchanges and in DeFi in general is there is many approaches. One approach is to do auctions. So basically, auctions approach means that if there is a ordering of transaction in blockchain system, we can maybe do an auction that people compete to buy specific slots in the block, and then the auction mainly going to do something that the one that paid the most going to have a higher priority. This is one approach. However, there is some issues with auctions because it's first you need to find a very efficient auction and not an auction that's going to make people spend more than they want. But additionally, it's create an issue about inequality because priority means people with more resources going to have, of course, the priority. Another way to deal with the orders issues and specific price manipulation is having in your atomic transaction a slippage protector. So as you know, when you trade now in decentralized exchanges, you can set a minimum amount of tokens that you want to get from your swap, and then it can protect you against sandwich attacks. And if you set it correctly, you can if you do it correctly, you can protect yourself from sandwich attacks, as these two papers shows. Another approach is to do batch auctions. So as I mentioned, in traditional markets, batch auctions is one way to deal with high frequent traders. There is a way to implement batch auctions on the blockchain. One issue with batch auction on the blockchain is that the computation to do it's very complex. Most of the time we're doing it off-chain, not on-chain. But this is another way to deal with the and by the way, batch auction means that you take all the transactions that waiting to execution, and instead of executing them in any specific order, you just like give all the transaction one clearing price, and then there is no any advantage of when you send your transaction because all of them going to get the same execution price. And finally, and this is most related to what we are trying to do, there is two papers of greedy sequencing rules that basically offer you can think about it as a rule of thumb or whatever, that a validator should follow, and once they follow this rule is guarantee preventing sandwich attack, which is the most common price manipulation, and it can improve price stability. And what we want to show is that we found a way to improve both goals of these rules in a very efficient way, and this is the main contribution of the paper. So to kind of conclude, first kind of main idea of the project was to say what is the social kind of benefit of order that we want to achieve from ordering transaction in AMM, what we want to set as a goal, what can be something that everyone going to benefit. So what we think is, we call it price stability, or you can think about it as minimum price volatility. So basically the idea is that traders want to trade from AMM. Given that AMM has a pricing rule that's going to determine the price of the transactions, and based on this pricing rule, we think that trader observe this price of the pool and they think that this is the price that they're going to get when they trade. So that's why we want to set a goal of ordering transaction in a way that people will get approximately this price, because this is what they expect to get. And that's why we want to minimize the volatility of the transactions from this price when we pick a specific order. So the way that you can think about it, you have a lot of transactions and you want to minimize this volatility. And why we think that it's good, beside that this is what people expect to get, it's also going to improve transaction success. So basically, if people will have a slippage in their transaction, so it's going to improve the probability of transaction to success, because then we are deviating more from what they expect to get. So we are deviating less from what they expecting to get. So it's less likely that it will make the transaction fail. So this is basically the main agenda why we pick this as a goal. So given that, what we basically want to do is we want to find the optimal way that pick a set of pending transaction and order them in a way that's going to minimize price volatility. And we will show an algorithm that can do it efficiently. And after, we want to play around with two ways that we can think that the algorithm can even more improve the price volatility. One is by increasing the batch. So basically it means that instead of ordering 10 transactions, we are increasing the block size. So we have much more transactions that we are going to order. And this we going to even more improve the price stability. And finally, we're going to show that if there is a way that we can incentivize traders to split their transaction under this algorithm, we can even further improve the price stability in AMMs. This is the big picture. Any questions, or we can start going in?
So you don't, I guess this is more jumping into the solutions, but you don't really, like, is transaction privacy a possible solution here, or do you not deal with like that at all? It's more on the ordering.
Yeah, just ordering of the transaction and no privacy or basically the idea is I will show some examples. The idea is that there is few transactions that need to be executed in a one liquidity pool in one block, and there is many different results of which prices each one will get different which order you pick, and we want to play in this environment.
Because like, I mean, I agree that these are good goals, like price stability, like submit the transaction and get the price that you saw when you submitted it, and like have less transaction failure. But it seems like, you know, like for example, for a sandwich attack, you either accept the user transaction or you accept the sender transaction, right? Not both are going to go through. So one is always kind of going to fail, right? So in this case, like optimizing transaction failure doesn't really help, right? Or like, is there something else to this that?
So just to see if I get your question right. So you basically saying that because I think when there is a sandwich attack, I will go after if you want to on the sandwich attack example. But sandwich attack, basically what's happened is that because the pricing rule of the AMM, an attacker. So if I'm the only one that's going to trade in the AMM, the attacker see my transaction. So what he's doing in a classical sandwich attack, he will put so if I want to buy Ethereum from a pool versus stablecoin, so the attacker will buy Ethereum, will make the the next transaction, which is going to be my transaction, be with worst exchange price, and after he will do the opposite transaction, so he will sell Ethereum and he will get a very attractive price, and he will get basically will get a profit on my back. So once you have a rule that by the order doesn't allow to do buy, sell, in a sense, then given that the attacker knows that this rule is going to be enforced, he will not send his transaction. So his transaction not going to be failure in this new domain, if it makes sense.
Okay, yeah, I think I can see.
So yeah, I will show some examples. So I hope it will make everything even a little bit easier to follow. So the main contribution will be, first, we're going to show a simple and fast algorithm that, which is the CLVR, that order transaction with approximately minimal or almost minimal price volatility. Then we will show that under CLVR, if you can have more transactions, so bigger blocks in our bigger blocks in our definition is the amount of transactions that going to be executed, and it's mean how many transactions you can order. So basically, the more transactions you have to order, you're going to see that it's give more flexibility and you can improve price volatility. And I will also show what I mentioned before, that if traders can split their transaction, it's also going to improve the volatility. And finally, we will test CLVR on empirical data, and we'll show you the potential to improve price volatility in current AMM settings. So let me explain basically the model. It's if you have any questions about how AMM works, feel free to ask. I little bit assume that you know it, but if someone have a question, feel free. I know it's not easy to understand right away. So basically, most of DEX platform work on AMMs, and they use different pricing rules formulas, but the most common is the constant product market maker. Basically, this formula works in a way that you have a supply of token X, which is this. You have the supply of token Y, and the product between the supply of the both token equal to a constant K. And this basically going to be the pricing rule that the formula always need to follow. So what it basically means is that, and in any given moment, the ratio between the tokens will be the exchange price. So if you have same amount of token of each token, then the price will be intuitive, it will be 1. But the idea is when you have less one token versus the other, then it's make the token with the less liquidity be more expensive relative to the other, which is kind of a basic demand and supply kind of a relationship. So the idea how it works is that this is the pricing rule. So when a next trader want to trade delta X from the liquidity pool, it always need to be that the amount that he will give to the pool, so he will give up token X, the amount of token Y that he can withdraw with the pool must be in a way that this equation still holds. So it's still that the product of the two supplies equal to the same K as the T in the period before. So this is how the price rule. So now go back to what Aviv mentioned. So it basically means that if we have 10 transactions, after each transaction, the price will be updated accordingly. So the order of the transaction matter, and the order of transaction will directly influence the price of each transaction. So the way that we need to think about this problem is that if we have a set of pending transaction M, each transaction can be either sell token A or X or buy token X, so it can be to both direction. It can either you give token X or you can even give token Y. It's whatever you want. But we're going to have a set of those pending transactions. And the question is now how we decide which transaction will be executed first, and then which transaction will be second, and so on. And we know that the order will directly impact the price of each transaction. So let me give you an example just to understand how it works. So imagine that we have 4 trades, okay? Each one of them want to either buy one token X or sell token X, and it's 10 units just for simplicity. So the idea is that if we start in a case that both token equal 1-to-1 ratio, the order of the transaction will impact each trade. And let's just give an example. Imagine that we're going to start with do buy, and then sell. So in that case, you can see here, okay, out left, you can see the exchange price of the other, like how many tokens from the other type of token I will get for each transaction. And what you can see is that when you do buy, sell, you are deviating more from the initial price, so you have much higher price volatility than doing buy, sell. And this is basically the power of ordering and the impact of ordering on the exchange price. Any questions? I think because this is kind of the core idea that I want to see that it makes sense. Make sense? Okay. So now, what is the optimal ordering of transactions? So what we going to do in our case, in order to play around is, we will assume we have a social planner that can decide which order you want to order the transaction. It's his rule, okay? He can do whatever he wants. And based on what I'm going to set as the economic measurement function that I want to optimize, then I can pick the order that's going to give the best outcome given this goal. So in that sense, if I'm going to decide that my goal is to reduce price volatility compared to initial prices, I can have this function. So basically what this function is doing is P0, it's the, if I go back here, P0, it's the price of the pool before we start the new block. So what I'm basically going to do in this function is I'm going to say I want to have the minimum deviation from the initial prices after each transaction. So basically after each transaction for a specific order, I'm going to calculate the deviation of each transaction from the initial price. And then I'm going to use log because it's this function because it's very common to do it in finance for calculating price volatility of stock markets. And while I do this, I can calculate for each specific order what will be the price volatility if I'm going to implement a specific order. And as you can think about it, given that I am going to have many transactions, I have many different permutations, orders that I can play around, and basically, without having any algorithm that's going to be it in a fast manner, a naive approach will be I can go over all the permutation, calculate the price volatility, and pick the specific permutation that's going to give me the lowest price volatility. Okay, so this is the way that I can achieve the economic goal and pick the optimal order that satisfy this function. Any questions? And as I mentioned, we set P0 to be the price, the opening price of the pool, because traders expect to have this price, and also this will reduce the likelihood of failure of the transactions.
Well, the best way to find the order is just to test everything.
Yeah, but it's going to be, I will explain you why we need to find an algorithm, because it can be very costly once you have more than even 30 permutations, because the number of permutation, it's
Yeah.
So just to give a specific kind of example to show how like you're going to order transaction under this optimization rule is will always be to kind of try to shift between buy and sell transactions. However, because you have few buy and few sell, it's also the algorithm need to do it in a clever way, in a way that pick the buy and sell transactions that fit each other in a way that reduce price volatility. So basically, you want to find a way to be always as closest as you can to the initial prices. And it's not always only shifting from buy and sell, it can be a little bit more complex, but this is kind of the big intuition. And I will give you some examples to show you cases that it's a little bit less trivial. But this is basically the idea. Now, as you mentioned before, like, of course, the best way to guarantee the minimum price volatility will be to go all over the permutations. However, we have two issues with it. It's become very costly when we have a lot of transaction waiting to execution. So we want it to be fast. And another issue is that if we want to make it be in a way that people can verify that the validators or block builders are following this rule, we want it to be easy to verify by others. So people can monitor that indeed block builders follow this rule. So that's why going over all the permutation is not something that is realistic, and we need to find a fast way to do it, to develop a algorithm to do it. So in the past, there was something that's called the greedy sequencing rule, okay, which is a rule that the main idea of this rule was to actually prevent sandwich attacks. And the way that they define the rule is as follows. You start with any trade, so it can be either buy or sell. And then if the price is above the status quo price, which the P0 that I mentioned before, you pick, if you have, a transaction from the other direction. So if you start with buy, you're going to pick sell. And again, if there is no sell, so you will keep having buy. And you're going to repeat 2 and 3 until your choices are executed. So let me kind of give you an example how it works, but GSR is, there is a proof that is prevent traditional sandwich attacks. And it's very easy rule to monitor because anyone can see if an order follow this rule. It's easy. You don't need to spend too much calculation power. So basically how it works, imagine that we have this set of pending transactions, okay? And the direction mean if it's buy or sell, and the legend of the arrow mean if it's a big or small transaction or whatever. Now, what's happened with GSR is, if you're going to see here, there is nothing that they mention about which transaction you need to pick in terms of like the dollar amount of the transaction. Is just the direction. So basically, the way it works is you pick any buy or sell transaction, but for simplicity, I pick, let's say I pick buy. Then because I am now deviating from the initial prices and I have a sell transaction, so I must do after a sell transaction. After I need to do buy again. I have another sell transaction. I do need to do another sell transaction. Now here, the way it works is because I didn't cross the initial prices yet. So under GSR, I need to do another sell transaction, and then I will do buy. So this is the way the rule works. You are doing a transaction. If you're deviating from the initial prices, then you need to come back. However, if you don't come back fully, you need to do another transaction from the same direction, and so on. Does it make sense? This is the GSR. However, there is some issues with the GSR, and we will show you that we can improve it and have an even better price volatility. Again, GSR main rule was to prevent sandwich attacks, not to reduce price volatility. We're going to offer something else to reduce price volatility. So in our rule, we say instead of the algorithm go over all the permutation, maybe you can always think about the next step. And the idea is I'm always going to pick the next transaction that's going to give me the minimum price volatility for the next step. Okay, so that's why we call it a looking forward volatility minimizing. It's always look on the next step. So after each transaction, we will pick the transaction that available in the rest of the transaction that's going to minimize price volatility. In our paper, we show a proof that it's prevent sandwich attacks, and I will show you later that it's doing better relative to the GSR. So basically, how it works with Clever, always we will pick the smallest transaction in the pending in the mempool, and then we're always going to pick the next transaction that's going to have the lowest price volatility after the execution. So it's going to be the orange, and then we're going to have the green, black, purple, and brown. So basically, it's always pick the next transaction that's going to minimize the price volatility. So I will show you more examples later, but specific for that example, we can see that the price volatility of GSR is higher than the price volatility of Clever. And we can see that the order is a bit different. Any questions, or we can go to evaluation?
Yeah, I don't understand how, I mean, what do you mean when you say it's verifiable? Because there's no agreement on like the mempool, right? So
Yeah. So yeah. So for now, think about the way that you think about the mempool is, for this example, is just like think about it now, it's just like a simulation. It's not what's happening in reality or whatever. In reality, I know that people can send their transaction via private pools and whatever. It just the way that I want to think about it, there is a set of transactions that need to be executed in specific liquidity pool, and now you can order them in a way that improve price volatility. I use mempool just.
No, yeah, I just didn't understand because you had said both GSR and your scheme are verifiable or credible.
Oh, okay. Yeah. So the way that I want you to think about it is that it's depend on which forcing mechanism you're going to have to the rule. But the idea with GSR, what they have in mind is that if we can set a norm that say all the block builder need to follow GSR, so it's verified in a way that it's easy for users to monitor, to look after each block on the transaction order and say, hey, they follow GSR. And if not, they can say, oh, this validator misbehave, and we can have a incentive mechanism to splash him or whatever. So it's easy to check that people follow the rule.
Sure. I guess it's just not possible to verify censorship, but the rest is possible.
It's easy to monitor maybe, and people think that monitoring can be a way to enforce, but it's not censorship resistant or the way I think it was to give some intuition that people can use this and then find a more kind of robust way to implement it on blockchain, because it will be easy to monitor.
Yeah, thank you.
And it can be reliable in the sense that, you don't need each one of us don't need a fancy computer to look on the current execution order and say, oh, they follow GSR. It's very easy. Like everyone can look any block, and if people follow GSR, it's right away you can see it.
Basically, but the rule is like, if I can't, like, for example, what if I just do 2 buys in a row, like, so that I can't do that at all? Or I guess I could do 2 buys in a row. Like, if I have a leftover buy, can I execute it, or I don't execute? If it's over the
So you can send any transaction that you want, but when they order it, they must follow the rule. So basically, the idea is that if there is a lot of buy or sell orders left, they must be executed buy, because there are no flexibility to do sell. That you don't have sell transaction to do. So always you're going to have a big tail in the end. This is also for our algorithm. It's always the case that when you have a lot of one direction transaction, the order, it's there is less flexibility there. The beauty of the order is when you have buy and sell transaction that you can cancel out. I have something with my.
One quick question. Are there, what would happen if there are 2 sequences of trades that lead to the same volatility? And that would, I mean, they need not be the same, right? Like different people might get different outcomes, but the volatility stays the same. How does the sequencer choose?
So the sequencer, let me see if I get your question right. So you basically you're asking if there is few buy and sell, how you choose if you're going to be the one that deviate from the price deviation or bringing the price back?
No. Wait, I'm sorry, like I don't understand your counter question. No, what I meant is, see, 2 sequences of trades, like buys and sells, can lead to the same volatility computation, right? Like that can happen just based off, maybe buy, sell, and buy, sell both lead to the same volatility for some values of buy and sell, maybe depending on the order of which buy I take, which sell I take. So now at this point, how do we choose which one to go for? Because one sequence of buy, sell might be advantageous to maybe say party A, and the other one might be advantageous to party B. So how do you ensure fairness, I guess, in this situation?
I see. So yeah, so I think so first in GSR, it's right that you have many different orders that can so if you have a set of pending transaction, one issue with GSR that there is many different orders that follow the rule. So it's not just unique one solution. And in that case, it can be tricky what you pick. Under our clever rule, it's most of the time there is a very low number of orders that follow the clever. So basically, the only thing that is different in clever is that if you have two buy and sell transactions that are in the same size, you can have a situation that two different orders of the same pending transaction follow clever, and you need to pick one of them. You're right. So this is a good point. We don't solve these cases, but we feel that under clever, I feel that it's much less likely to have few orders that follow clever than the GSR. In GSR, it's much common that you have many options that follow GSR. So yeah. But yeah, it's a good point. I don't know we don't have a solution right now of what you do in that case.
And do you know what GSR does in this case?
So GSR, so there is a improvement to GSR. There is a GSR is a modification to GSR that what they say that you always start with the smallest transaction. So it's reduced the set of orders that follow the rule. Yeah. Okay, let's maybe continue. I'm just like have an issue with my screen. I don't know. Try to. If I have a technical issue, I just went out from the view to. Maybe you can guide me.
Maybe you can exit and join.
Maybe I will stop sharing, try to share again. Okay, great. Thank you. Sorry. Okay. So let me show you some kind of results. So what we did in order to evaluate how clever is doing relative to GSR, what we did, we took the biggest Uniswap version 2 pool that have two stable coins and 2 million liquidity for each token. The price is around 1. We did it for simplicity because it's easier to follow. We took empirical data of all the transactions that people trade on this pool, and we create a synthetic distribution of transactions that follow the empirical transactions. And then we start checking how clever ordering transaction doing versus GSR for different number of transactions. So basically, it's the amount of transaction that you need to order. And so here we ran a lot of kind of simulations, and we checked. So we ran like the simulation, and we checked like which time clever give a better price volatility relative to GSR. We use the aged GSR, by the way, the one that I mentioned before, that we always pick the smallest transaction first and on top of it apply GSR. And what you can see is that, of course, with two transactions, it's trivial and they're going to be the same. But the more transactions that you have, we can start seeing that there is kind of convergence to 80% of the time Clever is giving better price volatility than GSR. However, when we compare the price volatility of Clever and GSR to the minimum price volatility, so minimum price volatility, it means that we run all the permutation and we can find the price volatility that give the minimum, the order that give the minimum price volatility. And we can only do it until 12 transactions, because once you have more than 12, it can take more than 1 day to go over all the permutations. And what you can see is that Clever has almost zero price volatility, very low, while GSR has almost 4% even after 12 transactions, which I think this gave us kind of the intuition that Clever is giving a much better performance than GSR. So just to give intuition why Clever order do a little bit better than GSR is, here is an example of 6 transactions. You can see that the VA GSR is ordering the transaction in the orange manner. So you do a buy and then you must do a sell and then buy. And because the sell transaction is so big, it's kind of pushing all the transactions to be in a very high price volatility. Then what Clever is doing, that is smoothly do all the transactions that are relatively close to the initial prices, and in the end only basically the last 2 transactions are having the bigger price volatility. This is basically showing you the difference between Clever to VH GSR. And when we do a t-test, we can see that we in the more transaction we have a much more statistical power of Clever versus the GSR. And this is kind of the first part that I want to show you. The second aspect that I want to show you, that I think it's another direction that people need to think about. So right now in Ethereum, in AMM, when you trade, the transaction execute every block. Every block is around 30 seconds, I guess. Aviv maybe know better. 30 seconds, 12 seconds?
12.
So every 12 seconds. However, one of the advantage of ordering transaction is when you have more transactions, you can improve price volatility. So imagine that you have a pool with 2 stable coins. And as a designer, you can push people and say, instead of running these orders every block, let's say that we're going to bundle transaction from 5 blocks and then execute them in a big batch. So what we did here in this exercise, we say, okay, we have a batch of 100 transactions. If we do them every block, this is going to be the price volatility of the transaction. If we bundle them in 10 transactions and do 10 transactions per block, this is going to be the price volatility, and so on. The more transactions,
You have 5 minutes.
Okay. The more transactions that you have, you can see that you can really improve price volatility. And the idea is that because you have more buy and sell transaction to cancel out, so you can smooth the prices more closely to the initial prices. So this is kind of a nice result. And given that I'm running out of time, so I'm not going to go over splitting transaction, but basically, if trader with big transaction can split it to small ones, you can have much better price volatility than having two big transactions. And now I want to move to kind of the most interesting aspect that I think about why we care and why we want to implement Clever on AMMs. So we took data from Ethereum, one of the biggest pool of USDC and Ether, and we checked like for blocks that have more than 3 transactions, because less than 3 transactions, the price volatility has no so impact. And we checked what was the current price volatility relative to the optimal, the minimum price volatility, and how is VHGSR and Clever doing relative to the minimum price volatility. And we can see that Clever is almost having no price volatility compared to the minimum, which means that it's a good approximation for price volatility. However, we can see that there is a lot of volatility in the current ordering of transaction relative to in the initial prices, and maybe we can improve it by implementing Clever or something else. And another nice result that we did, we took a lot of transactions from the stablecoins pool, and we did the exercise that I mentioned before, that what happened if AMMs will little bit allow to bundle transaction for few blocks and then execute them all together after few blocks. And we saw that if we increase the blocks to be 10 blocks together, we can reduce price volatility in stablecoins by 85%, which is nice. So I think this is kind of the main. So let me conclude, and then if you want to ask more questions. The way that you can think of Clever is a new way to regulate transaction ordering. It's going to protect users from sandwich attack and other stuff, but it's also give a public good for everyone, because everyone will enjoy a better prices, because price will be less volatile. We offer the Clever method that is a easy and fast way to get the minimum approximate minimum price volatility with a low computation cost. It's also prevent the traditional sandwich attacks, the 3 transaction sandwich attack. And we show that with larger blocks, we can even improve price volatility or more. So this is something that builders can think about, maybe implement it on the blockchain. And also price volatility can even improve more if traders will split their transactions. And now the question is how you enforce and how you implement Clever on AMM. So we have few directions how you can do it. First is if people are going to use AMMs in centralized exchanges like Coinbase, so they can force and implement it built-in, because they are the centralized organization that run the AMM. However, if we think about blockchains, there is 2 ways to do it. One is to build a hook on Uniswap version 4 that try to implement it on chain. Another approach is you can try to force this ordering rule on the blockchain level, on the validation level, and there is the Prof work about it. So Prof offering a way to implement this kind of rules, and they just can pick our rule as one of the way to implement ordering rules. And I think that's it for now. Thank you so much. If you have any questions, feel free to ask.
So, Mir, we don't have time for questions.
Okay.
Or there's supposed to be another thing in this class, but no one's coming, so maybe we have time for one.
Yes. I was just thinking, do you think about also, like, how fast is it, or is there a fast way to also like update online the ordering? In case you get, like, you have an ordering, let's say, for a bunch of transactions and new transactions come in. You want to like place them in this order that you already have. Is it easier, or do you have to recompute everything?
So I think like one of the trade-off when we think about implementing it is, and this is the complexity, is that doing it on chain, it's expensive because you need to do all the computations on chain, even though they are much easier than going on all over the permutation. It's still costly to run anything, you know, especially on Ethereum. And if you do it off chain, people will argue, okay, it's not decentralized, but running it on doing the simulation, everyone can do it in his own computer. It's not it's not hard to do it, but it's the challenge, how you can do it in a reliable way that people will trust you. And the question is if you do it off chain or on chain. Yeah, it's the challenge. If you have a good way, or let me know.
Yeah, got it. No, I understood that. Thank you.
So thanks again, Nir.
Thank you for asking me. Good questions.